Uber stock is down over 25% in the past 6 months. Investors are terrified that autonomous vehicle technology will make Uber obsolete. In my previous video about the stock, I said that it was a massive opportunity, but after missing their quarterly earnings target, the fear only intensified. So is Uber stock still worth buying? Or is the company set to lose out in the autonomous vehicle revolution? First, we're going to take a look at Uber's recent earnings miss, because there's more to this story than you get from just reading the headlines. As we see here, Uber actually beat analysts' estimates for revenue, albeit only slightly. In terms of EPS, analysts were expecting 79 cents per share, which Uber failed to meet. However, the reason for this earnings miss wasn't due to subpar business performance. It actually comes down to an accounting rule. Uber has many investments in smaller companies, and when the value of those investments go up or down, it has to be accounted for in the company's earnings. In this case, Uber had to submit a $1.6 billion loss on the value of their investment portfolio. Importantly, if you add this $1.6 billion back into Uber's net income, they would have beat analyst estimates for earnings per share. I think this is why the stock hasn't actually declined a huge amount since Uber reported earnings on February 4th. Now, if we actually take a look at what was said on the earnings call, we can get a clearer picture of how Uber performed during the quarter. Uber's management team described Q4 2025 as another great quarter, with the number of trips across the entire business hitting a 15 billion annual run rate, and now more than 200 million monthly active platform users. That's up from 171 million a year ago. So this is clearly still a fast-growing business. Q4 gross bookings were also up 22% year over year, which is actually a slight re-acceleration. Then for the full year in 2025, Uber produced a record $9.8 billion in free cash flow, up 42% year over year. This is the lifeblood of the business. This huge pile of cash can be used by Uber to invest back into the business, buy back shares, and pay down debt. The idea of investing back in the business is extremely important at the moment because of this monumental shift towards autonomous vehicles, with the market currently fearing Uber's ability to transition. Management indicated strong momentum entering 2026, with a scaled and profitable platform and confidence to make targeted, growth-oriented investments while continuing to generate significant free cash flow. Speaking of growth-oriented investments, on March 19th, Uber announced they'd invest up to $1.25 billion into EV maker Rivian in a deal to launch 50,000 robotaxis. So whilst investors have been worried about AV makers like Waymo and Tesla disrupting their business, Uber's quietly been making big moves in the background. The deal includes expectations for Uber or its fleet partners to purchase 10,000 autonomous versions of Rivian's upcoming R2 electric vehicle, with the option to buy up to 40,000 more robotaxis beginning in 2030, according to a release from the company. The deal is the latest in a resurgence of announcements about autonomous vehicles and robotaxis, as companies attempt to capitalize on what investors have forecast as a multi-trillion-dollar market. And that multi-trillion-dollar framing was emphasized numerous times in Uber's last earnings call. Uber sees AVs as a multi-trillion-dollar opportunity and a structural amplifier of its platform's strengths: global scale, dense demand, marketplace technology, and operational experience. Management frames AVs as augmenting, not replacing, existing ride-sharing. AVs are expected to expand the overall mobility category, and the early signs are positive. In markets with AV activity such as San Francisco, Austin, and Atlanta, Uber reports accelerating gross bookings, faster new rider growth versus the rest of the US, and strong trip frequency. So despite the bearish narrative around AV disruption, Uber is making fundamental gains. Uber asserts that AVs on its platform are showing 30% higher trips per vehicle per day versus first-party standalone AV platforms, and better ETAs, leading management to claim the best AV product is an AV on the Uber platform. This data suggests that AVs are most efficiently utilized on Uber's platform versus the Waymo app, for example, probably because Uber has already got huge demand. By adding AVs on top of that network, you only make it stronger and more capable. And the Uber strategy becomes even clearer with each announcement. On February 23rd, Uber announced their Uber Autonomous Solutions platform. They say Uber Autonomous Solutions is a comprehensive suite of unique services and capabilities that are already helping partners to build and successfully commercialize autonomous vehicles in multiple markets around the world. Uber CEO Dara Khosrowshahi said innovation in autonomy is moving quickly, but meaningful commercialization will take much longer. For more than a decade, Uber has helped set the standard for on-demand mobility and built the capabilities that make push a button and get a ride work at global scale. With Uber Autonomous Solutions, we're externalizing these hard-won competencies for our partners. Beyond just getting access to Uber's leading demand marketplace, Uber Autonomous Solutions goes further, providing the capabilities required for true end-to-end commercialization, reducing cost per mile, while increasing speed to market. They also bring comprehensive product development and support capabilities designed to make autonomous trips more reliable for users and more economical for operators. So like Visa and MasterCard in digital payments, Uber is providing the infrastructure for AV companies to run a sustainable business through the Uber network. But instead of banks, in the case of Visa and MasterCard, Uber is working with AV companies. And then if we take a look at super investors who own the stock, one stands out more than the rest. Bill Ackman of Pershing Square Capital Management has almost 16% of his portfolio invested in Uber stock, which equates to a near $2.5 billion investment. Bill Ackman's always followed a concentrated investment approach, but having a 16% position in Uber stock in his portfolio signals strong conviction and suggests that Ackman thinks this one could outperform the market long term. But let's talk about the risks for a moment. AVs are currently a loss-making venture for Uber, and management doesn't expect them to be profitable for several years. To scale AV supply, it's going to take billions of dollars, as seen with Uber's $1.25 billion Rivian deal. There's uncertainty around how long it will take for these AV investments to pay off. Long term, AVs will eliminate Uber's biggest expense, their human drivers, but that could take decades to materialize in a profitable way. There's also margin pressure from all these growth-oriented investments. Rather than expanding margins, Uber is prioritizing investments to build the AV future that we all expect. You've also got investments in their grocery business and their Uber One subscription service, which hit 46 million members in Q4. In the long term, I see Uber One as being the foundation of Uber's business model, a bit like how Amazon uses its Prime subscription to lock in customers to their ecosystem. Now let's take a look at Uber's valuation to see what price we'd have to pay in order to achieve market-beating returns. First of all, from a price to earnings perspective, Uber trades at a forward PE ratio of 20 times and a forward PE of just 17 times based on 2027's earnings estimates, compared to a competitor like DoorDash, which is growing bookings slightly faster, but trades at a forward PE ratio of 53, making Uber appear relatively cheaper. And then on a free cash flow basis, Uber trades at a 6, almost 7% free cash flow yield. Even after subtracting stock-based compensation, you've got a free cash flow yield for Uber at over 5%. Then if we compare this to DoorDash again, they trade at a just under 3% free cash flow yield and under 2% when accounting for stock-based comp. Again, Uber looks relatively cheap. One of Uber's biggest rivals in autonomous vehicles is supposedly Tesla. I say supposedly because they're yet to actually conduct a paid ride with their driverless technology without a supervisor being present in the vehicle. Tesla currently trades at a forward PE ratio of 172 times and a free cash flow yield of less than 0.5%. If DoorDash didn't make Uber look cheap, then Tesla certainly does. Now let's use Qualtrics' DCF calculator to come up with an estimate of Uber stock's potential return over the next 5 years. We'll value the company on a free cash flow basis. Uber's free cash flow per share growth has been superb over recent years, going from negative to explosive profitability. However, I'd expect that to moderate significantly in the next 5 years. Gross bookings are still growing at above 20% annually, and I doubt free cash flow growth will be far off of that. With potential share buybacks once growth-oriented investments slow down, I think it's quite reasonable to expect Uber to grow free cash flow per share at 15% over the next 5 years. Then in terms of free cash flow yield, Uber stock's trading at the highest yield in its history as a public company. That's despite continued revenue growth of 20%. Assuming Uber continues to navigate the AV revolution successfully, I don't see why the shares couldn't trade at a free cash flow yield of around 4%, which again in that case may be slightly conservative. Based on these assumptions, Uber stock could provide an annualized return of 27% over the next 5 years, rising from $72 per share today to $240 per share by 2031. That's more than a 3x return in 5 years.